Tesco shares slumped by the most since June 2017. That's after first half adjusted operating profit fell short of expectations driven by weakness in Poland and Asia. Investors shrugged off a beat on UK like-for-like sales and an increase in the dividend. Eric Moore is a fund manager at Miton Group and joins me now on set to discuss. Eric, so there were 11 straight quarters of rising sales in the UK, the best sales growth in over a decade according to CEO Dave Lewis, but it seems like the market is very, very focused on this operating profit number. Do you think that it warrants the massive decline in the shares that we've seen today?
Yeah, the market is being quite harsh with Tesco's today, I feel. I mean, there was a lot of good news in the results. As you say, the UK is continuing to improve. So if you cast your mind back since Dave Lewis came, this was, the company was in very difficult position and there's been a sort of recovery. I mean, it's going pretty well. So, they said their margin targets for the medium term are on track. They aspire to 3.5% to 4% margin. And, the UK sales are positive, and if anything, if you look at the detail, the numbers of Q2 was better than the Q1, so it's a good trend and an improving trend. Booker that they bought recently is absolutely gunning along, so Booker grew by 14.7%, I think, which is tremendous. So the UK picture was pretty good, but the trouble is that the Asian profits were down 29%, and I think that blindsided a lot of people because people don't really think of Tesco's as still as being an international business. They kind of think of the Tesco's we see here in the UK, but the Asian business, even with the profits down 29%, it's still 100 million profit on a base of 930 odd, so it's more than 10% of the group. And if that's going backwards at that sort of rate, down 29%, that makes a mess of the numbers. So
you mentioned the operating margin there. It came in at 2.94%. It's got this 3.5 to 4% target by fiscal year 2019 to 20. Yeah. Do you think that's achievable?
It should be. I mean, in the old days, the company made a sort of 6% margin in the UK, so it's not going back to previous peaks, but I think the world has changed, so the world is sort of more competitive. There's the investment on online, which is included in that number somewhere, although they don't really split it out, but that will obviously be dampening a little bit to profits. But I'm slightly surprised that they put that target out there. I mean, it's not a new target, that target's been out there for a little bit, but it does feel like a bit of a hostage to fortune in what remains a very competitive market, and you have a lot of uncertainty about how the consumer's feeling. But it's certainly doable. On the maths, it's doable, and if you believe it, then on a very big revenue line, every little bit of margin improvement makes a big difference to profits. And if you believe it and are prepared to look out to 2021, then the shares don't look particularly expensive.
Now, you're obviously an income investor, so you must be pleased by the increase in the interim dividend coming in at 1.67 pence a share.
Yeah, so it looks tremendous because it's a 67% increase, but I'm afraid you have to remember that that's only really because they cut the dividend to nothing much in 2015 when the profits collapsed and they had accounting scandals and all that. So the dividends are growing back, but from a very low base. So if you look at the total yield on the share, it's still not that attractive. So the yield is not yet kind of eye-wateringly attractive to me. Now
let's talk about Jack's, because that was Tesco's response to the German discounters, really. Yeah. But it's interesting to see that Aldi has now responded to Tesco this week, saying it's thinking about cutting prices. So it seems like prices are ratcheting down further and further. Is it just a race to the bottom? And do you think this is the right move for Tesco?
I think it is the right move. I mean, obviously it's very small, so we're talking about one store, but it's quite interesting because it's a sort of a sign that the fight back starts here, and that we're not just going to continue to cede market share to the German discounters. We're going to do something about it. The other thing that's important is, this perhaps explains some of the strategic rationale for the Booker deal, because I think it's quite a lot of the Booker know-how that's being brought to bear to the Jack's offering. So although Tesco's are at pains to say it's actually going back to their roots, because it's Jack Tesco 100 years ago, he was just selling, a few things cheap, and that's how it all began. Actually, this offering looks more like what Booker kind of do. But I think it is an important kind of effort to draw the line. But does it mean that the Germans are suddenly going to be, losing share? Well, it's one store. I mean, the Germans still have, the German discounters, Aldi and Lidl, still have a lot of opportunity to grow share. I think in the long run, it's perfectly possible that the discounters get up to a 20% market share, and that means they've still got quite a long way to go, which again will continue to pressure the big name prices.
Yeah, so Sainsbury's obviously is going down a different route in order to think about how to compete against these discounters, and of course Amazon, it's looking to tie up with Asda. So do you think that deal will go through, and what would that mean for Tesco?
I was very surprised when the deal was announced because I just thought the market shares are going to be prohibitively high. So if you put Sainsbury's and Asda together, you've got over 30% market share of the grocery market, and Tesco's is kind of already nearly 30% by itself. So if you're looking at that as a regulator, you're saying, you know, we've got supermarkets where everyone shops. It's, you know, it's a very visible category. You know, everyone's a consumer of these companies, and to have the 60%, over 60% market share in the hands of two players seems too high to me. Also, there's a new head of the competition bodies, the guy Andrew Tyree, who was head of the select committee in the Commons, and I think he'll be quite pleased to make his mark. So you know, he's not going to roll over and have his tummy tickled on this.
Yeah, he was pretty tough in the select committee, wasn't he?
He was, yeah. I mean, he was good, but tough. And I think, you know, this isn't going to be settled quickly. But you know, the Sainsbury's management have been asked in, you know, a lot of detail what gives them the confidence that they can get this deal approved, and they say they've gone through it in minute detail, postcode by postcode, and they're very confident. And I think, in fact, the Sainsbury's chief executive has said, well, you know, in effect, he's staking his career on the doability of this deal, and I guess, you know, he's got better information than me. But I think it's going to, at best, it's going to take a long time to sort out. The competition body is going to want to have a very good look at it, and I think during that period, I wouldn't be surprised if Sainsbury's suffers a little bit of the eye off the ball. So I mean, if you're one of the many thousands of staff there, you're going to feel a little bit anxious about what happens next. If you're one of the many hundreds of thousands of suppliers, you're going to think, well, how am I feeling about supplying these guys? Do I really want to help them at the moment when I know they're probably going to be looking for price cuts once the Asda thing goes through? So I think there's, you know, the very top management will be spending all their time, you know, poring over spreadsheets of postcodes of where the shops are, and so I think it's a risk there's a little bit of eye off the ball, and that's probably good news for Tesco's at the margin. Yeah,
so it sounds like Sainsbury's is really in a period of flux, and perhaps Tesco could benefit from that.
They've got a lot. Sainsbury's certainly have a lot on their plate. I mean, there's no evidence that there seems to be any slowdown, but you know, you'd feel it's kind of the way the world goes, that I wouldn't be that surprised if there's a little bit of eye off the ball.
So I had a quick look at the PE ratios before we came in, and it's 19 roughly for Tesco versus 23 for Sainsbury's and 25 for Morrisons. So I'm wondering why Tesco is trading at a discount. Presumably there's some kind of M&A premium built into Sainsbury's. So, I mean, do you think that Tesco looks attractive from a valuation perspective here?
Yeah, I mean, all of these companies are looking quite highly rated at the moment for because they're all of them really are like Tesco's, coming back from a very grim period in 2015 when you had a lot of deflation on prices. So their prices were going down, but costs are going up. So margins got really squeezed. They've also had to grapple with online investment, and they've also had to grapple with you know, sort of the invasion of the discounters that we talked about. So there was a really tough period of you know, profit collapse, really, including they all cut their dividends. It wasn't just Tesco's. So now now that there's some signs of recovery, the market is being forward-looking, putting these companies on what looks like quite a high PE, on the view that that recovery has still got further to go. So as I said, if you believe that Tesco's get to their margin target, then that PE comes down quite quickly, and it's similar at Sainsbury's and Morrisons.
So in terms of your stock preferences in the sector, where does Tesco sort of sit?
So the only grocer the Miton Income Fund has any holding in is in Morrisons. So I mean, I don't think there's anything particularly wrong with Tesco's. As I said, I think the fall is a bit overdone on a very short-term view. I wouldn't be surprised if it makes back some of the you know, from where it is now. I imagine it'll probably end the week a little bit higher.
So what is it that you like about Morrisons? Well,
Morrisons, I think, is again, it's kind of outside the immediate focus of what's going with Tesco's and Sainsbury's Asda, so it's quietly getting on with its own recovery initiative, which has many similarities in that they're focusing back on the customer, on the quality of the offering. They're focusing again on their own employees. Happy employees is an important part of the successful ingredients of a grocer. And again, they're getting the margin improvements through. What differentiates them a bit is that they have more of their own supply chain. So they actually, you know, back integrate all the way into potatoes, and so that gives them a bit more pricing power. What's interesting for the whole sector, though, is we've been through a period of price deflation, which is very hard for supermarkets, because it means every week people come back, they're getting more for less, and that's very difficult for the profit and loss accounts of the grocers. But now we're seeing a bit of price inflation, which is the opposite. So you know, prices are going up, and they're passing that on, and that helps all the wheel of the P&L account. So I think the outlook for the whole sector is improving at the margin. It's still a tough business. So you know, we're as consumers, these are fantastic businesses because we get tremendous variety of great produce. There's a shop on every corner. They're open all hours. I mean, it's brilliant as a consumer. As a shareholder, these businesses don't make great returns on capital employed. So, you know, the customers are the winner here, not necessarily shareholders.
Eric, thank you very much.
Thank you.
That was Eric Moore, Fund Manager at Miton Group. I'm Victoria Scholar. Thank you for watching IGTV, and we'll see you very soon.